Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so last lecture, right? Yeah, should be pretty relaxed. No new content, nothing like that. I'll talk a little bit about the final. I'll talk a little bit about the practice exam, and then I'll talk a little bit about my experience at Credit Suisse. And I wasn't just in Credit Suisse; I was in stockbroking for a year as well, in the building across the street, actually, at Dixon Advisory. Yeah, I can see them still. No, I like them. I had a good time there, so I learned a lot. So no ill feelings or anything like that. But before, let's get, first of all, I'll get to my talk about the final exam. So first of all, the final exam, you should know this. You should be doing this for your other courses as well. You should know when the time what the time and the location of the final exam is. Obviously, it looks like a split. Looks like a split venue, which is just wonderful because timetabling hates me. They do. I don't know what it is. They just don't. They don't like anyone. So, but they particularly hate me, right? So, not good. Not good. So they're punishing us as always, or punishing me at least. So we have most of us will be actually in this building downstairs. I'll be here during the reading time, and then a few of us will be in Copeland. I'll go there after I finish the reading time there, so if you have any questions, just wait for me to show up. I'll go to Copeland G29 once the reading time here finishes. With the exam, like with most of my exams, you'll have plenty of time. So don't worry about the time. Don't rush. Read everything 6 times. You don't have to start writing. I mean, you can write on the exam paper during the reading time if you want, but you don't have to. My recommendation to you is to read everything to make sure everything's clear. Ask any questions while I'm there, and then you can start writing. But it's your exam. You can do whatever you like, but that would be more sensible to me, right? So, because then I'll leave, and then you'll have 3 hours to do the questions, which is plenty of time, right? Plenty of time. So a few things. Remember, we need a non-programmable calculator. Programmable is no good. It will be taken off you because you can program it to have notes in there. You don't need to do that because guess what? A4 page with notes on both sides. Thank you, Joseph, right? So See, you're not polite. You should say thank you. No. I don't like testing memorized. In an introductory finance class, it sort of makes sense, but in a class like this, valuation, which is more later year class, I don't like asking students to memorize stuff. I think it's silly. So make sure you write your notes quite well. The font, there is no requirement, so write it as small as you like, as large as you like. It's up to you. It can be handwritten, it can be on a computer, whatever you like. It's your page, one A4 page with notes on both sides that you can do as you like. And when I was in this class, we had one A4 sheet with notes on both sides for the final, and actually me writing that note became revision for me. So it was actually a learning exercise as well, writing the notes for the final exam. So please take it seriously. It's something that you will have for 3 hours to help you with the final. If you do it last minute, the night before or 2 days before, not good. It won't work. You should have, if it was me, I would have started already, right? Because you've got so much content that you can write already. We finished all the content for the semester, so you should be well on your way in writing that. So if you're not writing it, you're behind. Please take it seriously, and please don't leave it to the last minute. Yeah? And no, you cannot share during the exam. I had one time, I had an exam, oh God, and I had a student say, oh, my friend has better notes, can I just use, during the exam, no. Right? Before the exam, you can sell your notes. Who cares, right? It's your choice. It's your paper. But well, my chest was. I'm a young man still, sort of, but my left arm was. There was a pain shooting down here, right, which is not good. And dictionary, please don't get caught with notes in the dictionary. That's so stupid, especially in a class that gives you notes. You laugh, but I once set an exam which was open book, full open book, and the person brought a dictionary with notes inside. I don't understand. I honestly don't understand, right? If it's open book or if it has A4 sheet of paper with notes on both sides, you don't need to write notes in your dictionary. First of all, it's against university policy. It's called cheating, which you can get kicked out of the university for, so don't do it. And second of all, you don't need to memorize. You have notes in this class, so please don't do something stupid like that. It's very, very silly. Yeah. So please get working on your A4 sheet of paper. I think it's very important. It's very, very important that you write that well and you take it seriously. Yeah. And we have the venue, we have the time, we have the date. In terms of consultation, I'm actually not so, let's look at this, November, right? No dates? Here we go. Next month. So that's here. I'm not in Canberra on Monday, so best consult I'll have a consult on Friday, the 2nd of November. So if you have any questions, please come and see me in my office. I'll post the official time on Waddle, but I'm actually not here. I come back, I think, Wednesday night. So I won't be in my office if you want to see me on Monday, just warning you. But I'll be here Friday, so please, with any questions, you can email me, of course, during this time when I'm not here, but if you want to see me in person, please come Friday, the 2nd of November, to my office. Yeah, with any questions? And there'll be tutors will have consults, just to answer your, if you're wondering that, your tutors, both Hera and Jan, will have consults somewhere here. And the tutorial questions are important for the final. Yeah. So let's talk about this final. So I promised you some hints. Let's have a look. Let's see what I can tell you. Is this good? Yeah. So what's examinable? So obviously lecture notes, very important that you're familiar with all the lecture notes. Even the stuff that you didn't need for the assignment, stuff I talked about last week or the week before that. So the assignment was on DCF and ratios, but I gave you a lot of other content in the lecture notes as well, so you need to know all of that. Next, the workshops. Workshops in terms of valuation. Remember, the workshops in this class were really there to help you with the assignment. Obviously, there will be no JB Hi-Fi questions in the final. You can use that. At some point, you'll be asked to give some examples of companies. You can use JB Hi-Fi as your example to answer the question. But you don't need the stuff I taught you specifically, like you don't need to remember the net debt for 2018, something stupid like that, no. But what I did teach you in the workshop is some additional valuation, actually how to calculate beta, how to calculate ratios, how to, all the hints and all the advice I gave you for the 2 assignments is relevant. So what I'll say is the workshops are not directly examinable, but the valuation aspects is something you definitely need to know. Don't ignore the workshops. Don't just say, oh, that's just JB Hi-Fi. I don't need to know that. No, don't do that. Next, what you need to know is the tutorials. Yeah, so all the tutorials and the tutorial answers and the content is examinable. I will be taking some questions from the tutorials. So if you say, oh, the tutorials is very different. I said this in the first class this semester. The tutorials are very different to what Joseph said in the lecture notes. That means it's not examinable. Wrong. Very wrong. Very, very wrong. Yeah, so you need to know those questions as well and the answers. Then the mid-semester. Well, it's not a mid-semester. It was an online test on Waddle that you did, and you did quite well. Please take a look at those questions. You're gonna, like I told you before a few times in the class, and you'll see that today with the past exam, I'm going to be asking you how to calculate NOPLAT. Right? You can expect that question number 1, calculate NOPLAT. Right? Question number 2, calculate invested capital. Question number 3, calculate ROIC. Question number 4, calculate free cash flow. Right? I'm going to be asking you those questions. So you did well in the online test, most of you, but don't get arrogant. First of all, it's all with the online test. You could have maybe Excel next to you, open on the other screen or whatever to make the calculation quicker. You don't have that luxury in the final, right? It's all handwritten. It's all in a venue. Your computers, your phones, your tablets, whatever it is something you cannot use. So it all has to be written. So the process might be slower, a little bit different. So don't get arrogant. If you did well in the online test, good for you. Yeah, good for you, but be expecting the same questions again. Yeah, please. So definitely review those questions. So what do we have? Lecture notes, workshops, tutorial, online test, and the past exam. So the past exam is here on Waddle in this section, week 12, which is where we are today in the practice exam. So I'll go through that today. Yeah. So that's what you need to be revising in this course. Now, this happens every semester, and I understand it, but I'll just give you a warning. Don't send me emails, is this examinable? Yeah. Or the other variation of the same question is, do I need to know this for the final? I'm not trying to be rude, but I will not respond. It's very easy, those emails, just select delete, right? Very easy to address those types of emails for me. And I'm not trying to be rude, it's just a question I cannot answer. So if you don't know, assume yes. Right? So you can send me those emails if you like to be annoying, but I won't answer. Yeah. And you're wasting time. Okay, so let's have a look here. So the final. I would say the split is between sort of 40% theory, 60% calculation. The online test was all calculation, I think. Yeah, so this is more theory. They will be both theory and calculation. There will be multiple choice and short answer. So written, if you like, questions, answers. Same thing here, calculation. Some will be MCQs, multiple choice questions, and the others will be short answer. So the final exam has 40 questions. Out of those 40, 24 are, if you like, MCQ calculation based. and about 12 are MCQ theory. And the other 4 are short answer. I think it's like half a mark here or something like that, half mark each. Same thing here, half mark each. You won't get penalized for incorrect answers, so you should answer every single question, even if you're guessing, but don't guess. The exam, you know, I get asked this question a lot as well. Is the exam difficult? It's to be frank, it's a silly question. I wrote it. To me, it's not difficult because I wrote it. So for you, yeah, sure. Everything's difficult if you have to think, right? So the exam will ask you to think. I think it's, if you think the online test was quite easy or quite appropriate, you can expect that sort of difficulty. It's just longer, right? Because it's more content, right? So you can expect that sort of difficulty. But to you, it will seem more difficult because you don't have the answers in front of you. And because I wrote them, I had them, right? So difficulty is a subjective thing, which is impossible to answer. So out of the short answer, 2 are calculation, 2 are theory. Yeah. With the theory questions, it will ask you to explain some stuff. You don't have to give me an essay. You can do bullet points, right? It's your time. You can write as much as you want. I'll read it. No essays required. It just requires bullet points, if whatever format suits you best. So that's the structure. Structure it any way you like. As I said, the 15 minutes, what is it, 15 minutes reading time? Let's have a look here. 15 or 30? Doesn't say. I assume it's 15 minutes reading time. You know, start with reading the multiple choice questions or read the short answer first, whatever works for you. Again, time is not something you need to worry about in my exams. You will have the time to finish the exam, right? Don't rush. Don't go, oh, I don't. Yeah. No, don't do that. It's silly. You're stressing yourself unnecessarily, right? So it's all going to be questions you've seen or seen some variation of it, either in the lecture or while doing your assignment, seen it in the past exam or the online test, right? So I don't ask questions that you've never heard of, right? That's some lecturers do that. I always found that frustrating and unfair when I was a lecturer here, a student here, but I don't do that. Okay? I try to be fair, well, in my opinion. Right. So that's the structure. Any questions on the structure? You can ask, be brave. I don't bite much. Okay. No emails to Joseph. No. Is this examinable? Every time, every semester. Not good. Right? So if let's say in the short answer, the theory question asks for an example, you can use JB Hi-Fi. It's a company you should be familiar with, but you don't have to. You can use, like I did in my lectures, you can use Wesfarmers, you can use Westfield, you can use Cochlear, you can use Tesla, you can use whatever you like, right? Whatever answers the question. Yeah. Okay, so let's go to the past exam here. So the past exam, let me have a look here, starts with the multiple choice, and that's what this exam will start as well. Multiple choice, and you should find this, familiar. I sort of use this template for the online test, where you get a bunch of accounting information, maybe a very small income statement, small balance sheet, small either cash flow statement or some kind of a funding section to see how the equity section of a balance sheet. So this is a balance sheet asset section, liability and equity section, some variation of that with usually additional information that you need to answer the question. Right? So this was very similar to the online test. And then boom, question number 1. Right? What's an OPLAT? So you should be very familiar with that. And if you don't know how to calculate NOPLAT, not good. Yeah, not good at all. Then the usual suspects, right? Free cash flows, WACC, continuing value, DCF, that's too easy. Invested capital, ROIC. Explain the increase or decrease in ROIC. And then this, you didn't see this before. So that was DCF section. And then in the final, there'll be a multiple section as well, which you didn't see in the online test. But again, you'll get some kind of an income statement that you need, information that you need to answer the questions, a balance sheet, some additional information down here, and boom, normalize earnings. Right? I started grading the assignment. It will take me a while. A lot of you didn't do this well. Normalized. I only marked a couple of assignments because they take a long time to mark, man. Normalized earnings is something that a lot of teams didn't take seriously. Yeah, please take it seriously for the final. Right? So with the assignment, hopefully next week I'll email you your mark. If you, because time is so short, I don't have time to give you comments. But if you want comments of what I was looking for and why you got 10 out of 15 or 12 out of 15. You can come and see me in consult, and I'll tell you. But because there's no assignment 3, there's nothing to correct from assignment 2. So, and I'm short on time, just like everyone. So, no TAs, no teaching assistants. So, you'll just get a mark. But if you want more explanation, of course, my door's open. Or you can email me. Up to you, whatever you like. So, normalize earnings, then normalize and dilute earnings. All right. What is the current P ratio? Right? Some explanations about relative P. Yeah. What is the book to market or book to price to book? Right. What is the dividend yield? Yeah. EBITDA, calculate EBITDA. Using that EBITDA, what is the enterprise value multiple? And value the company using this multiple, right? So the answers to these questions are here. Also in the week 12 section of Waddle, and you have the DCF section, and all the calculations and formulas are here. So invested capital calculation, ROIC calculation somewhere here. Capital turnover ratio, sales divided by operating invested capital, NOPLAT margin calculation. Hopefully that should be very familiar. So you've seen this before in the online test. What you haven't seen before is the multiple section. So things like, calculate normalized earnings, calculate diluted earnings, calculate diluted normalized earnings per share, yeah. Calculate the current P ratio, calculate the price to book, calculate the yield on dividends, calculate EBITDA, using the EBITDA, calculate the EVM. Using EVM of what 5.2 the question said, calculate a value per share. Right? Things you did in the second assignment, but I didn't test that in the online test, so be prepared for these sorts of questions. The structure will be the same. I'll give you, for the ratio section of the MCQ, I'll give you again accounting information, maybe some additional information here or some information here, and please read everything. So I get a lot of questions when students view the exam or something about why was it done this way. Well, please read, everything, not just the numbers. Everything should be. Again, you have 3 hours and reading time as well for an exam that you really need 2 hours to do. Please read every single thing carefully. Right? Goodwill impairment charge was not tax deductible. Right? You needed that to make this so that in your calculation that sort of makes sense. Right? Assume book value is a reasonable estimate of market value for other claims and assets. In other words, just use the book value. Right? So please read everything. And when you're practicing for the final, one way to make your practice more real is instead of, when you may be doing these questions, instead of going to the answers and figuring out, oh, that's how it's done. Try it yourself, make a mistake, and learn from that mistake. Right? The true mistake is not learning from your mistakes. Everybody makes mistakes every day, all the time. We're imperfect human beings. The true mistake is when you don't learn from that. Yeah? So if you just go to the answers, you're not learning. You're just going to the answers. But everybody's mind works differently, so it's your choice how you study. I'm just saying that in the final, you obviously won't have the answers like this, right? So it's a different. If you're studying by going to the answers, it's not good. It's not realistic. So my recommendation to you is before jumping to the answers to figuring out if it's A, B, or C, or E, or whatever it is, you try it yourself. You study, have your A4 sheet of paper next to you, and try to answer these questions without going to the answers. And then you make a mistake and you figure out why. And that's what learning is, in my opinion. So after the calculation MCQ, you will get theory questions like this, right? So the answers to this are all to the end. Again, looking at the answers is very easy, so you can do that. But my recommendation for you is not. So with the theory questions, stuff that maybe is not specifically answered in the lecture notes, but if you are familiar with the lecture notes, you should be able to answer. So which of the following approaches does not require capital structure to be considered in how cash flows are discounted on the basis that it is relevant for cost of capital, right? So this really is asking for the DCF lecture, whatever it's lecture 5 or whatever it is. Enterprise DCF, do you need capital structure? Yeah, of course, right? Equity cash flow valuation? Yeah. Economic profit? Yes. Adjusted APV. So it should be none of the above, I hope. So when you go to your answers here and you go to 20, none of the above. Right? They all require capital structure. So next, so the theory questions are maybe not explicitly in the lecture notes, but they're implicitly. So if you're studying and studying properly instead of just memorizing, you should be able to answer. Your forecast for company turnover, and I tell you what company turnover is. Wow, so nice. Revenue divided by operating, it's invested capital. I don't like that. So in here it says operating invested capital. That's silly because there's no such thing as non-operating invested capital. All invested capital is operating, right? So the operating shouldn't be there. I don't know, bad template. So what do we have here? Forecasts for companies' capital turnover are increased. Okay, that's a good sign. That's a good thing. You're more efficient. Remember, capital turnover is like an efficiency ratio, right? Which of the following best describes the implication? The valuation decreases. You already know that's not true. When efficiency goes up, valuation goes up. So no. B, your valuation increases because capital is released from the business. That makes no sense. Capital, you don't want capital released from the business. You want to be using that capital to reinvest in positive NPV projects. Your valuation increases because the amount of capital required to support growth is reduced. This goes back to the Crown Casino example. I think growth lecture, whatever it was, lecture 8 or 9, I talked about that you want to invest in companies that go ex capex because one of the key fundamental requirements for growth is to spend. But if you're more efficient than your competition, you have to spend less to grow same or more. You're worth more. Yeah, your valuation is higher. So I think the answer is C. Your valuation decreases because additional capital is invested in the business? Yeah, that's not good. So 21C, hopefully. So those, let's keep going. What else is here? Listed below are 5 methods for forecasting capex, which will most probably generate poor forecast and misleading valuation. This is from lecture 2 or 3. When I talk about the capex, I've got a whole slide. And one of the things I specifically say is the worst thing you can do is forecast capex, that's fine. Estimate maintenance capex directly, that's fine. Forecast capital spending directly, project, that's fine too. Yeah, that's what I'm looking for, right? You cannot, I've seen analysts do that, but you cannot set capex equal to depreciation. You will underestimate depreciation every single time, and your valuation will be too high. Right, so 24D is the answer, I hope. Forecast stocks of fixed capital forecast stock or fixed capital as a percentage of revenue and back out CapEx required to reach the target quantity of fixed capital after allowing for depreciation. I don't like that method, but that's what method number 1 does, by the way. So that's what most of you did in your assignment number 1, so that's fine. So 24D, I assume, is the answer. So sometimes they're crossed. When they're crossed, you don't need to worry about it. I consider it kind of something I didn't talk about or something that's not very clear. What do we have here? Another theory question. A number of adjustments need to be made to NOPLAT to derive free cash flows. Indicate whether any of these items listed below are not included in these adjustments. So NOPLAT, when you're going from NOPLAT to free cash flows, we need to add CapEx, we need to subtract CapEx, subtract changes working capital, add depreciation. So first of all, you need to know that, because question number 1 is going to be calculate NOPLAT, but also a definition. Let's have a look here. So do we need, we'll be adding depreciation, yes. Capital spending, we need to subtract capital expenditure. Changes working capital needs to be subtracted. Investments in goodwill upon acquisition, so that's the trick. That's actually, that's included. We didn't have that for JB Hi-Fi because we assume that the company won't do any acquisitions in the future, which is probably incorrect, but we don't know what acquisitions when. So, but D, investments in goodwill upon acquisition. Any investments that the company has to make, they need to spend money. You can think of that as CapEx, essentially. Adjustments are required for all these, so the answer should be E, I think. 27, huh? E. So this is talking about leases, so technically I can ask you this question, but I think I don't like definition type questions. They're a little petty in my opinion, but using the CAPM for estimating cost of equity, we did that in the assignment, includes generating a beta. This might be done through linear regression. This is what we did, of the returns on the stock versus the market, some kind of a benchmark. We did that. However, betas estimated by regression analysis can be unreliable. Which of the following actions is least likely to generate useful insights into the potential accuracy of any regression-based beta estimate? So this goes to the cost of capital lecture and my example of estimating beta. So estimating beta of different periods, you should do that. That's a good thing. And we did that, right? Both weekly and monthly, different time periods. Examine the scatter plot. I showed you that. You need to do that. That's a good thing. Examining the R squared from estimating regression, that's useless. No good. So I don't care that the R squared is 1. That doesn't mean anything. Checking for consistency with betas observed for the industry. We did that. I advised you that, and most of you did that, also did beta for comparable companies. Examining data time series for evidence of serial correlation. That's what the Scholz-Williams and Dimson beta is all about. It corrects for serial correlation, which linear regression assumes doesn't exist or is very low. So we did all those things except for, I never mentioned, and I hope I never mentioned, I'm pretty sure I didn't, choose the beta based on the R squared, right? If somebody's teaching you that, then they should be fired. Right? That's very stupid. Oh, this one, R squared is 5, not 4%. Not good. Okay, crossed out. What else do I have for you? An intern produces an enterprise DCF valuation for a friendly company, a specialist retailer. Ooh. We value the retailer. After you ask the intern about ROIC assumptions underpinning the valuation, they produce the chart below. Which of the following explanations for this ROIC trend might lead you to accept the valuation as plausible? That's a very good question. So we've got a chart here of ROIC that's currently around 12%, and it's going to not that much high. It looks high because the scale is just 1% here, but it's going from 12 to 15.5 and then staying at that. So a little increase. It looks a very large increase because this scale is so small. but a reasonable increase of couple of percent. Okay, so and you're asked to find which explanation of these 5 is most plausible. Okay, companies aggressively cutting costs, and these plans have been built into the forecast. When companies are aggressively, a company should cut costs, right? Should be more efficient. Nothing wrong with that. But when they're doing it aggressively, that's usually because they're restructuring the business. A business that's being restructured doesn't have increasing ROIC. Right? Even if it's a good restructure, it at least takes a couple of years. So no. A substantial proportion of costs are fixed. Margins simply rise due to operating leverage. That makes no sense. Leverage is a balance sheet item. ROIC is an income statement item. Companies benefiting from investments already in place. Capital turnover rises as more sales are generated on the existing asset base. Looks very good. That's a good answer. That's certainly plausible. Company is a superior operator in a niche market, and its main competitor has just exited after suffering years of losses. If that actually happened, your ROIC would not increase 3%. Your ROIC would double, right? If you're a superior operator in a market with not a lot of competition, and your main competitor has gone bankrupt or exited, your ROIC should be like that, right? So that's possible, but in practice, when that happens, ROIC goes up a lot more. This is what the company's investment bankers are forecasting. They should know. No, they don't know, especially investment bankers. First of all, investment bankers are not equity research analysts, right? Investment bankers are salesmen. That's a nice way of putting it, right? Investment bankers, they're nice people. I worked with them, but they think they're much better than they are. They don't have to do analysis. Not much anyway. Equity research is actually what the forecast that you should be paying attention to. So it's, to me, it's obviously C, 33. Yep, C. What else do I have for you in terms of theory? These sorts of questions that you can expect. With some acquisitions, while some acquisitions create value for the acquirers, shareholders, the majority have not done so. So this is the acquisition lecture, the growth lecture. In which of the following situations is an acquisition most likely to be successful in this sense? Company states the acquisition is EPS positive in year 1 at current interest rates. So if the acquisition is EPS positive in year 1, that's not bad, but at current interest rates is very risky. Interest rates are volatile, right? They fluctuate. So if you are assuming that your transaction will be EPS positive in year 1 at current interest rates, you're sort of crossing your fingers and hoping that interest rates don't increase, right? Which is not good. You shouldn't hope. Meets the cost of capital hurdle after allowing for synergies. Ooh, ouch, not good. So you have to have synergies in order to be NPV positive. What I talked about in acquisitions is synergies are very risky, very subjective, and a lot of the times when the two companies come together, synergies are overstated. And elevates the company to 3rd largest by market share. Third largest, not bad, but not good. So I would be very skeptical if that's what the management team was saying about the acquisition. The acquirer has a successful track record of acquiring companies in the same industry that operates of a similar production and distribution platform to the acquirer. That's good. That's very good. That's what you want. I talked about, I think, QBE in the lecture, about them being hardened for battle, and then them doing targeted acquisitions of small insurance companies that have the same business, right? So they can scale, essentially. So you acquire small companies to get their customers, and then you use your economies of scale and scope as a large company to reduce your costs. Yeah, that's good. Most of those acquisitions are successful. You're buying a management team. Look, I talked about management team a lot, and it's very important to have good management, but if that's all you're doing, that's not enough, right? You need to buy assets, not just the management. Okay? The company states that the acquisition has been done for strategic reasons. Ooh. Every time I hear that, I laugh, because don't do anything for strategic reasons This is a valuation course. We care about value. We don't care about strategic reasons, whatever that means. That just means, like I said in the lecture, that the transaction is NPV negative. Yeah. Never invest in a project or an acquisition that's NPV negative. Right? In particular, benefits are expected to flow from becoming the largest player with 40% market share. Market share only seems like it's important. It doesn't hurt. It's good to have good market share, stable customer base. It helps. But when Apple started making phones, their market share was 0. Right? And Nokia had a 65% market share. Now Nokia is bankrupt. Right? The company states that the acquisition will be EPS positive in year 3 once synergies are realized. Yeah, not good. So it's going to be positive in year 3. It's going to start creating value in year 3. Conditional on synergies. Again, synergy is very subjective. Be very skeptical as an analyst if a company is just talking about synergies of why they're, synergy this, synergy that, synergy this. Synergies they always say they're going to be, very efficient together. They're going to use, they're going to use their scale and scope. They're going to use their network, the distribution network, blah, blah, blah. Sounds good, but in practice, synergies are hard to realize in acquisitions, right? So I assume it's B is the answer. What's this? A company is considering launching a takeover bid and wants to know the price that it could pay for the acquisition to be EPS neutral. I don't think I had time to go through EPS neutral in the class. It has estimated the target's EPS after synergies would be $1 per share. The potential acquirer has the option to either fund the acquisition with debt at 7 or issue equity expected to trade on a P of 16. The tax rate's 30. What is the maximum the company can pay for the acquisition? EPS neutral. So I wouldn't examine that. That's from a example that I don't think had time to go through. Supplementary documents, acquisition analysis. That requires the EPS neutral formula, which is actually that. You don't need to know that for the final. EPS neutral sounds sexy. It's not. Yeah. It's not that important. Yeah. Yeah. But if you use that formula, you would get whatever the break-even PE is. So it's asking, what this question is asking for is what's called a break-even PE, and using that formula from that template, you can calculate the break-even PE. But I wouldn't ask that. Next, another theory question, you can sort of see where I'm going that. So some sort of require calculation, but most of them are just you have to think about it when you're answering this question and rely on your lecture notes and what I talked about in class and the workshops and your assignment number 1, assignment number 2. I think if you took those assignments seriously, you would be better off sitting the final. Which of the following valuation is not based around capitalizing some definition of income? It's too easy. Price to sales, I see. P ratio, dividend yield, cash flow multiples, enterprise value. So all ratios we've seen before. So P ratio requires net income, which is income. Obviously, net income is income. Dividend yield is, again, income after tax. Cash flow uses NOPLAT, so that's an income. Enterprise value uses EBITDA or EBIT. So it's A. It's a sort of a trick question because the reason why it's A is sales is not income. Sales is revenue. Right? It's sort of deceptive. It's like, they all require income. And that is revenue, not income. Income is profit. Revenue is just sales. So it's the top line of the income statement. When normalizing earnings, which of the following items, I assume it's A. When normalizing earnings, which of the following items would not require an adjustment? So normalization. When you're calculating earnings per share or some kind of a long-term, sustainable, steady-state level of earnings. Amortization of software, redundancy costs, pension fund revaluations, goodwill impairment charge, tax load brought forward. That's a good question. So, in other words, this question is asking what is one-off, right? What is not every single year? So redundancy cost is not every single year. Hopefully, you're not firing people and transforming your business every single year. Pension fund revaluations don't happen every year, that's for sure. They happen, but not every year, so that's normalization. Goodwill impairment, again, impairment like the pension fund doesn't get revalued every single year. Tax losses brought forward. If you had some DTA and you used it, you can't use it forever, so that's not sustainable either. So it's actually amortization of software, so depreciation of your software is what happens every single year. So you wouldn't need to adjust for it. So 38A, I assume. Yep. And 39, last theory question example I have for you. Each of the alternatives offered below support three fundamental determinants of the multiple of reported earnings on which a company should be priced, which is more correct. So this is lecture 6, I think. So it's asking for the three fundamental determinants of all ratios. Relation of reported to maintainable earnings, yes. Ability to earn above the cost of capital, yes. Earnings risk, no. B, relation of reported to maintainable earnings, yes. Expected growth rate, no. Relation of reported earnings, reported to maintainable earnings, yes. Ability to invest above the cost of capital, yes. Cost of capital, yes. 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 I hope. D, a relation of reported to maintainable earnings, expected growth or earnings risk, no. So 39C, yeah. So the three determinants of all ratios are how sustainable are your earnings? Are you able to invest in positive NPV projects, so invest above the cost of capital? And what is your cost of capital? So I talk about that in lecture 6. Lecture 6, yes. So those sort of are the theory questions. So the reason why I went through them is because I didn't ask them in the online test. So expect something like that. Yeah. So they do require a little bit of thought. And again, if you get stuck, read it a couple of times. Don't just say, oh, it has to be B. Come back. You will have the time to answer them slowly and methodically. So expect those sorts of, that's what I mean by theory questions. So the short answer, the example I have for you, what do I have for you? Let's have a look. Practice exam, short answer section here. So it's 4 questions. What do I have here for you? I have 3, so it's going to be more than that, but let's have a look at an example. Share price of Acme Manufacturing Limited fell approximately 4% on the day it announced a record profit, up 30% of last year. Wow, very good. On the same day, ASX index increased 0.5%. Discuss the significance of market expectations of performance and the challenges companies face in this regard. So this is the investment decision lecture, really what this question is asking about. And it's really going to the fact that stock prices are a sum of expectations. You can think of that, you can think of stock prices in a number of ways. One way that you can think about stock prices for publicly traded companies is the stock price is a sum of future expectations. And if those expectations are for 40% profit, which is very high, a company does very well and does 30%, which you would think, wow, 30% profit, that's great, that's awesome. The stock price actually goes down. Despite such good news, 30% increase in profit, not sales, profit is very good. But the stock price still went down, and it wasn't because of the market conditions, because market actually went up 0.5%. So what the question is really getting you to answer and say is, stock prices are not based on results. They're based on how those results relate to what is expected. And if the expectations are not met, if their actual results are below expectations, the stock price goes down. And if the results the company delivers, reports on at the end of its financial year is above expectations, the stock price goes up. And you see this even when a company reports a loss. Qantas did this famously a couple of years ago. They had a huge loss, massive. Stock price went up. Right, billions of dollars lost. Right, a lot of that had to do with asset revaluations, but huge loss. Stock price went up 4%, I think, that day. The reason is the market was expecting a bigger loss. Right, they just lost less. right? So just because a company loses money doesn't automatically mean stock price goes down. It actually, because the movement of stock prices is how the actual results relate to what is expected. And that's what lecture, I think lecture 10, the investment decision lecture, I had a couple of slides there on this stuff. So the value of a company's share in the market is based on intrinsic value, the fundamental value, how much the assets are worth today. So when you hear the word intrinsic, you sort of hopefully think of options, because options are the right but not the obligation to buy or sell something in the future for a fixed price. And they have a time value and an intrinsic value. So time value is how long the option is for, 10 years, not 10 years, a year, 6 months, whatever it is. And then how much what the option is worth if it was exercised today. That's intrinsic value. So in valuation, when you hear intrinsic value, it means fundamental value. How much are the assets worth today? So the stock price, the value of a stock share, value of a company share in the market is based on this fundamental value, how much are the assets worth, and these market expectations. And what this question is asking about is the stock price is going down because while the company's fundamentals may be fine, the intrinsic value is fine, it has underperformed those expectations, the expectations of the investors, right? The market may be biased positively or negatively and may hold false expectations. And I gave an example of, I think, CBA, Commonwealth Bank, just because in the financial crisis it was a bank and people thought, oh, it's a bank, it's bad, you know, it has a lot of bad debt, and stock price went to like all the way down to like $26 a share. The company had no subprime mortgages, zero. It was well regulated, protected by law in Australia, because in the US they don't have a law that says protect the banks. In Australia we do. It's called the four-pillar policy. They had access to the discount window so they can get cheap government funding. The federal government insured all the deposits, so there was no run on the bank, but the stock price still went down, right? Incorrectly, right? Because CBA and all the big four commercial banks here in Australia, they were just banks. And 2008 was started as banking crisis is the wrong word. We had that presentation a couple of days ago. The gentleman from the Fed said it was a run on shadow banking. The problem with that is the shadow bankings were, the players in the shadow banking were actually banks, right? So they were both in the actual banking market and in shadow banking. So the decisions they made in the shadow banking market didn't help. It was financial engineering where this risk got sort of pulled together, subprime, diversified, and then sold off in tranches to investors all over the world, but all the underlying assets were worthless. They were all mortgages that were held by people who could never pay those mortgages off. Right? So CBA, because it was a bank, it was thought of as any other bank in the world in 2008, and the stock just went down, which was incorrect. Right? There was some negative bias. I think the example I gave in the lecture. Returns to shareholders depend primarily on changes to expectations more than the actual performance of assets. Yeah, because stock prices are the sum of expectations. So yes, they still depend on this fundamental value. And in the long term, it's always about the fundamental value. But these expectations do move share prices and can do very quickly, very aggressively. Challenge is to manage expectations. I remember saying that in the lecture as well. A lot of managers provide their expectations about the performance of the company. JB Hi-Fi is no different. You know, when you go to the annual statements for JB Hi-Fi, you go to the presentation each year. At some point, the management is going to give you their outlook, right? What they expect, what they're doing, and what their earnings are expected to be. They're managing expectations. They should do that. It's a good thing. That means the swings, if they do this, that means the swings in the stock price will not be as large, right? Because they're telling you how the company is doing before the actual results. Most companies do this, right? They tell you their expectations. In Australia, that's more important than in the US, because in Australia we have reports every 6 months. Which is quite a long time. In the US, it doesn't matter as much because they report every 3 months, right? So there's a more frequent updating of how the company is actually doing. But even in the US, even though there's a 3-month difference, 3-month lag between every time the company reports on its performance and it shows you their balance sheet, even they manage expectations, right? By telling how the company is doing in a particular quarter. In Australia, it's every semi-annual period, right? So one way you can avoid these sort of swings in practice is by having these management guidance or management attempts to sort of give expectations of how the company is performing before the actual results are announced. And it involves regular communication with the market in terms of asset performance and constant engagement with market to understand their prevailing conditions. In Australia, we actually have, they're called ASX queries. I actually did some research on this a while back. I think they don't have this in the US, which I think it's understandable because their market is 10 times larger than ours. But if you, let's say, I don't know, pick a small company, let's try RXP, IT company. Let's go to the announcements. More? No. Search again. What's a company that had recently no explanation? Let's try RXP. Query. Let's try. Maybe not JB Hi-Fi. We can try JB Hi-Fi. Yeah, see? It's called an ASX query. Basically, it's the actual market, the stock market, the actual company that manages the stock market, telling the company to explain movements in the stock price that are not supported by by new information being released or some change in fundamental value. So they don't have this in the US, but I think this is very good, a very good idea. It supports transparency, which is what you want. You don't want opacity in financial markets because if you have incomplete disclosure, what happens is you've got a lot of information asymmetry, which makes the stock vulnerable to large fluctuations. So if you want to lie, cheat, that's your choice. You go to prison, hopefully. The idea behind well-functioning markets is for you to be as transparent as possible. You cannot be full transparent because that means giving away company secrets and confidential information that you need to keep in order to compete with your competitors. But as much as you can, disclose information that is relevant to fundamental value, to the DCF price, the price of the value of the assets. And sometimes when there is a large movement in the stock price and there is no reason for it in terms of some new information that the company has released or annual statements being released or some kind of a specific event, the ASX, the actual company, the Australian Securities Exchange, actually asks the companies that are listed on the exchange to explain the fluctuation. Why is your stock price going up 10% for no reason? Right? And if they don't know, they'll say, we have no clue, which is an answer in itself. That means there's speculation on the stock. But if there's an actual reason, there's some M&A discussion that you're having with a competitor or somebody overseas coming to buy a big stake in the company, or we're in discussions for merger or something like that, then they'll say that, right? So in the US, they don't have that. It's just the market is too big and too fragmented, So even if there is no regular communications, what I'm trying to say is that the exchange forces you to have regular communication. That's a good thing. Yeah. In the Acne example, the 4% share price fall, even though the company reported record profit, indicates that the market expectations for profit were much higher than 30%. And the prevailing share price pre-announcement had factored in this expected information that results will be more than 30% increase in profit. Within this context, the market was disappointed and hence sold off the stock. causing the share price to fall. Note that the significant change in the share price cannot be explained by some market movement. And we saw this in the beta estimation, especially in 2008. It doesn't matter that you were JB Hi-Fi or Harvey Norman or whoever you were. In September of 2008, your stock price went down, right, a lot, like 28%. That's not your fault. That's just investors dumping stock and selling everything that moves and just being in cash because they're frightened. Yeah. There's a flight to safety. But when the market is flat or goes down a little bit or goes even up a little bit, and you have a 4% share price fall, that's because you underperformed the expectations. So that's a good question. I like that. That's a very good question. Right. And again, bullet points. You don't have to, but you can answer the question any way you like. Next question. Over the long run, there's substantial evidence to suggest that stock market valuations correctly reflect underlying value and its fundamental drivers. Yep. I discussed that again at lecture 10. But what about these circumstances when share prices fluctuate in unexpected and volatile ways? Discuss this in the context of mispricing in the market that can occur over the short run and corrections towards intrinsic value over the long term. It's sort of the same question as question number 1, so I wouldn't ask two questions that are so similar in the finals, just an example, but it's asking the same thing. Again, lecture 10, talking about expectations and how over the long term, the reason why we have a course on fundamental value is because over the long term, cash flows matter. That's why Bitcoin is worthless. That's why I shouldn't be buying that garbage, because the value is zero. All right, I can see what the price is, obviously. The price is whatever, but the price doesn't reflect value. And in the long run, everything goes back to the valuation, and that means cash flow, discounting cash flow to time zero. Right. So I won't go through this. The answers are here on Waddle. The answers are very similar. Again, it has to do with short term. There might be some dislocation or some bias or negative, positively bias or some false expectations. But in the long run, it's all about the cash flows, sustainability of the company. Those 4 things that I talked about in that lecture, stable competitive position, you have a core competency versus your competitors, all those things I mentioned in class. And question 3 is a calculation, but it's something simple like bare bones. Right? So I can ask you a DCF sort of question. It won't be that long. Because it's just it's a written exam, you don't have Excel, but something that is that I can ask you is some kind of maybe a shortcut version or a summed or a condensed version of DCF. Even though I ask you questions I will ask you questions in the multiple choice section with respect to DCF here. It doesn't mean I don't have to ask you. Remember, 2 of the 4 questions are calculations, so I can ask you some kind of a DCF or even a ratio calculation in the short answer question, short answer part of the exam as well. Right. So I think this is too much, a little too big. Maybe a shorter version of this. Yeah, could be. Right. So. Or bare bones or some kind of a very short model that you've probably seen before. Yeah, so be familiar with that. Can close this, yes. So the answers are here for the calculation, for the MCQ section, both the DCF and the ratio. So that's available to you. What else do I have for you? Let's have a look here. So yes, I'll go through some of my experience. So that's the content in terms of the exam. I'll have specific consultation for the final and my specific hours for Friday, week before the exam here. Did I add anything here? No, I think that's all good. Any questions? What the structure of the final? Something like that. Okay. So what I do now, this is obviously not examinable. I'll go through, right? You'd be surprised the kind of questions I get. Is this examinable? I don't know. I try, right? I'm very patient. So a few sort of hints or something I learned, something I could recommend to you in trying to get into finance, things that I read that I found helpful in my quest to get a job in finance that helped. The stuff I'll tell you a few real recommendations and hints and sort of my story, if you like. Remember that they're just my personal experience. They're not everybody's different. So this is what I did, but doesn't mean that you have to do this, or it's just my sort of reflection on the things that I experienced, that read, or did that helped me getting a job in finance. Yeah. So first, some reading. I always get a question from students on this. What should I read to help me about valuation or getting ready for interviews or something like that? Most interview books are a waste of money. The reason is obvious. They're just too general, right? They recommend the obvious stuff like be prepared. Really? You charge $100 for that advice? Right? That's ridiculous. Of course you have to be prepared for an interview. Right? Practice in front of an audience. Practice for your interview in front of, with your friend or a family member or something like that. Obvious as well. Arrive early. Well, of course you can't arrive late for an interview. Right? Try to sell yourself. Of course. Right? Don't be arrogant. That actually helped me. But you don't want to be passive, but you don't want to be too arrogant. You have to be somewhere in between. Read up on the firm and its recent activity. Again, obvious advice that you'll find in interview books. That is not very helpful. So the book that I read that is the best book by far to prepare you for an interview in finance is Tim's book. Tim Craig wrote this book called Heard on the Street, Quantitative Questions from Wall Street. It's not just quant, it's also qualitative questions in the second part of the book. A lot of the interview questions that I read there are actually questions that were asked of me in my interview. So that book is very good, and you don't even have to buy it. Just put it in Google, right? I'm winking, look at my eye, right? Yeah. So, yeah. So the other thing, if you want quant jobs, you'll actually sometimes be asked to do some math-type puzzles, surprisingly. I was, and some of them are not easy, right? They're not, Monopoly. It's not an easy type of questions that you get asked. These aptitude questions and quantitative aptitude questions are not easy. So to practice for them, some math-based puzzle books for quant jobs I did, and I found very helpful. I have a few still in my office. If you want to come by and borrow them, you can. But it's math questions, stuff that you wouldn't expect. Like what's 99 squared, right? Boom, right? And you're like, oh, no, it's too long. 9,801. So it's x minus 1 squared, right? You expand that x squared minus 2x plus 1. So that's 9,801, right? So you have to be able to answer those sort of questions on the spot straight away, right? And you'd be like, why are they testing that? They're testing your ability to do maths quickly in your head, right? And that's important when you're working in finance and you have a quantitative job. If you have a numbers-based job, it's an important skill to have. So if you want interview books, I can recommend this one. And you don't even have to pay for it, which is nice. Stuff that I read that was also very helpful about finance. Monkey Business that's classic. About investment banking, very good. When Genius Fail, Rise of LTCM. LTCM is a fascinating story, long-term capital management. That's John Merriweather. He used to be at Salomon Brothers bond trading in the 80s. That's how he got into the markets. And he basically started doing arbitrage on bonds. He got the idea from the 87 crisis in the US. So in 87, they had a recession. And what happens in a recession, the first sort of indication that you're in a recession is investors start selling stock and start buying government bonds. right, treasuries in the US. And what people did in '87 is they bought 30-year new treasuries. So 30-year bonds that were issued by the federal government. They sold all their stock and bought 30-year newly printed, so new bonds. And John Meriwether was sitting on the Solomon desk trading bonds, and he saw a huge price increase in the 30-year government bond because everybody was buying the bonds. And then he said, these people must be stupid. They're buying one bond. Why do they want just a bond that's newly issued? What about buying the bonds that were issued 6 months ago? They're 30-year bonds. So he didn't see any price increase there. He just saw all the increase in the newly issued bonds. So what he and his team did, they bought all these, they did an arb. They shorted the bonds the new bonds everybody was buying. And to hedge, they bought the 30-year bonds that were issued 6 months ago or a year ago. Essentially, the bet was that the relationship, the yield curve would equalize, and the relationship, the pricing difference between a 30-year bond that was issued now, 30-year bond issued 6 months ago would equalize. That's exactly what they did. And that's exactly what happened after the crisis. People were incorrectly pricing bonds because there was just a flight to safety, this fear of buying newly issued treasuries. Recessions don't last for 30 years. There's never been a recession that's lasted for 30 years. The longest is 10. You don't need 30-year bonds. And he correctly predicted that. Essentially, that was the downfall of LTCM because 20 years later. So when the fund imploded, what they were doing is these cross-correlation strategies that were just hoping that highly leveraged trading strategy where you would look for historical patterns between assets and look for dislocations between that relationship and then bet that that relationship would come back. And the reason why they failed is they had highly levered positions. So these were huge bets. These were $200 billion bets, right? So these were huge positions, and they got margin called. They couldn't come up with the capital, so they had to liquidate the fund and go bankrupt. But the idea is very good. You're just looking for mispricing using some kind of a long-term historical pattern between assets that are very liquid. Treasuries are very liquid, a lot of buys and sells every single day. So it's a very good book, LTC. You should read it even if you don't want to do finance. John Meriwether is a he failed, but there's a lot of lessons to be learned, and very smart guy, much smarter than me. And the fact that they failed doesn't mean that he's a failure. The strategy and the thinking behind his investments were brilliant. And the book talks about that. The Big Short, anything by Michael Lewis, I think I mentioned him before, you should read. He was there with John Meriwether at Salomon Brothers in the 80s trading bonds, actually. So he talks about John Meriwether a lot, Michael Lewis. But all his books are very good. Very good. Very, very good. So The Big Short, Inside the Doomsday Machine is about the financial crisis. Black Swan, Taleb's book, very interesting about black swan events. Hedge hogging, how fund managers actually don't do anything. They just copy, right? The Quants, also a very famous book that requires your attention if you like this sort of stuff. In terms of, well, there's a lot of things to watch. Look, my recommendation is to watch documentaries. Some of these are very good. Enron is a very good documentary about the company. Where is, yeah, scary, right? Whoa, whoa, go away, right? Yeah. Ooh, crazy guy. So, yeah, idiot. Where was I? Come back. Oh, yeah. Microsoft. Not good. ANU. It's rough. It's rough. It teaches you patience, this university. So while it's loading, so here in these documentaries, which are all for free, you can go to films. If it works. He even looks crazy, right? He's orange, first of all, which I mean, I'm not going to complain about someone's appearance, but yeah, not good. So you can watch documentaries about anything, but the finance ones are very good. What's the one I'm looking for? Yeah, in my mind, these are the best documentaries in the world, these frontline documentaries, really interesting stuff. So as you can see, we've got a lot of, it's very topical, right? So financial, because we're not in a crisis, there was a crisis 10 years ago, most of these you have to go back to find the ones I'm looking for. That's a very good one, Catch a Trader, why no trader has been prosecuted for blowing up the financial system 10 years ago. It's a good one. Cliffhanger is pretty good. It's not really financial, it's more the budget deficit in the US and how the country's broke and on the verge of collapse, which it is. That's not what I want. Yeah, so $6 million bet is very good. So that's John Corzine, former CEO of MF Global. He was at Goldman Sachs. He had these John Merriweather type of investments, right, where he was looking for relationship between assets. Money, Power, and Wall Street, it's how all the regulators are from Goldman Sachs and the whole system's corrupt. It's kind of funny. There's a few other ones that I can recommend to you. Let's keep going. The Warning is fascinating, but again, it's about the budget deficit. Breaking the Bank is very good. So this is the M&A between Bank of America and Merrill Lynch during the financial crisis. Madoff Affair is very interesting. Bernie Madoff, the world's largest Ponzi scheme. Very interesting documentary. Inside the Meltdown, that's what I want. So that's those 2 critical weeks in September in 2008 where the world stopped. The financial crisis really froze credit markets. And for a global economy that's built on debt and credit, when the credit markets freeze, 10 minutes later, when the credit markets freeze, the party's over. Right, so all those are very good. Open. Okay, but the other ones, Enron, I can highly recommend that. That's very good. Stuff like Rogue Trader, that's Nick Leeson. Very interesting story. He destroyed Barings Bank by taking huge positions on the Nikkei in the 1990s. Wall Street is a classic. It's more of a movie than anything sort of useful. Boiler Room is about stockbroking. Yeah, interesting stuff. Yeah. So all those things, if you find finance interesting, I recommend you watch. You learn a lot. In terms of my sort of advice for you, when you're applying for a job in finance in a bank, it helps to have one finance-related job on your CV before you start applying for jobs you really want. Right? I did this, and I found this was a very important thing. You shouldn't just have your university education is not enough for a job that you really want. So when I was applying for Credit Suisse, for example, I was already a stockbroker for a year here at Dixon Advisory, and that job really helped me because what you see is these companies get a lot of applicants, right? And one way they filter is by disregarding applications. Doesn't matter what your marks are, what your grades are, if you have no experience whatsoever. If you it is used as a differentiator. At least it doesn't have to be. You don't have to, if you want to be an equity research analyst, you don't have to be an equity research analyst somewhere else before you apply for a job at UBS or Morgan Stanley or Goldman Sachs. You can be a finance related, I was a stockbroker, right? So it's not equity research at all. So that one job is something that you do need these days because it's used as a differentiating factor between so many applicants these companies get. Because everybody wants to work at Goldman Sachs, UBS, Merrill Lynch, Bank of America, Morgan Stanley, all these companies, right? Also, that job, if you have something on your CV other than your university education, it's a proof that you have ability to work in a corporate culture, that you're professional, which is very important. It's also an opportunity to improve your communication skills. You know, me, just like a lot of people in this room, English is a second language for me as well. And by working at Dixon for a year, it actually helped me with my communication skills a lot. So I can recommend that as well. Communication skills, very important. They look for that in the interview, right? It's not just your answers to your questions, it's just how easy it is to communicate with you. That is very important. You want to, if it's one, that's good. If it's more than one, that's better. So you want to fatten up your resume early on to show that you don't just make the mistake of, oh, I'm going to look for jobs after I leave university. That's a common mistake. You want to start before you leave university. And you also want to have a diversity of references on your CV. You shouldn't have companies discount CVs that have in your reference section at the bottom of your CV, it's all your lecturers from university, right? You shouldn't have that. You can have one, so usually they ask for 3 references. They should not all be university lecturers. It should be one university lecturer. That's it. So please make sure that your references are diverse. And again, if you work somewhere else, you can use that as your reference on your CV. So your teachers should not be your references on your CV. Not good. So even if you're working somewhere that you don't really want to work in forever, it's important to leave a good impression, even if you're not interested in this particular job long term, because you want to use them as a reference, right? So when you're thinking of, even though you want to be in finance today, it's just not reasonable, it's not feasible, it's too competitive. You have to jump through at least one company, one hoop, in order to have some exposure before you're applying for the jobs that you really want. Right? So if you think that, oh, I'll just finish university, I'll have high distinction average, then I'll get a job. No, don't have that. That's a common mistake. Don't have that mindset. That's wrong. Man, you cannot be passive like that. So some jobs that you can apply for, it doesn't matter if it's not prestigious, whatever prestigious means, that's subjective. You can, like me, I will look for small brokerages, Big Four accounting firms. They're global, right? They're all over the world. Even if you don't have a right to work in Australia, there are businesses that don't require that. So you can apply for EY somewhere else in Asia, for example, right? So I had a friend, actually, Gary. Did I mention him? You have to be an Australian citizen to apply for Treasury, APRA, ASIC. That's because there's nothing against you or RBA. It's just for the security clearance. You cannot have a baseline security clearance if you're not an Australian citizen. So there's nothing against you. It's just norms that we have in Australia that you're handling sensitive information that is not public. So generally for government agencies, you need at least what's called baseline clearance. Right? So the example that I had there was Gary. So Gary now is at Macquarie. He's a fund manager. He's doing quite well. And he had this issue, I had this issue as well. I was an overseas student on international student visa, so we both had this issue that we couldn't apply for a lot of jobs because we weren't Australian or Australian permanent residents. But don't just get frustrated, try to work the problem. So Gary worked in, I think, Shanghai and Hong Kong for, I think it was Macquarie, actually, which is an Australian company, but they do have a Hong Kong and a Singaporean office, right? So I worked for Dixon because they didn't require you to be a permanent resident. I don't know about now, this is 10 years ago, so it may have changed, but try to find a place where it's this residency problem that a lot of international students have, including myself, is not an issue, right? Don't just get frustrated. So you do this again for you to achieve some kind of initial experience as soon as possible, right? You should get started. You should be getting serious pretty early, and in your last year, you should be looking for internships, right, and grad positions. Even if you have no interest in taking those jobs long term, you want to put them in their CV. Even if it's a 3-month internship, that's good enough. Doesn't have to be, you don't have to work there. I was a stockbroker for a year, but it doesn't have to be a year. It could be 3 months. That's enough. Undertaking initial employment overseas is a great idea, especially for international students without permanent residency. So experience obtained overseas with a recognized institution. Doesn't have to be Goldman Sachs, Hong Kong, but at least a recognized institution like EY or KPMG or something like that is equivalent to an Australian experience, if not more highly. It's more highly valued now because China is such a big market. If you speak that particular language, you'll actually have an advantage here in Australia. So what this is trying to tell you is you need some initial experience. You can't just wait to finish university and then apply for Goldman Sachs and think that you're going to get it. It doesn't work that way anymore. Maybe 30 years ago, maybe, not now. So one way to get this initial experience is through internships, right? Very important. So internships have become more and more important. Definitely something you need to pay attention to. It's really a gateway to full-time offer, to a full-time position offer. It was for me at Credit Suisse. I got into Credit Suisse by doing the internship, and then they liked me, so they gave me a full-time offer that I didn't take. But internship is a great gateway to a full-time position at the company or in the industry, the banking industry, if you want to work there. So, and this is true because interns get priority, right? So when you have, let's say, a company like Credit Suisse had 20 grad offers, it had 20 interns. Out of those 20 interns, it offered 10 of us permanent positions. That means the number of grads that we're looking for went from 20 to 10, right? Because interns were given priority. So grad offers are only advertised if there is room after interns have accepted their offers. And I remember one year at Macquarie Bank, all the interns accepted their offers, and there were no graduates being hired that year. Right? So it's important to take these internships very seriously. If the interns fill all the grad positions next year, usually what happens, you have an internship for 3 months, and then you're getting a full-time offer for next year when you finish your university education. If all the interns fill the grad positions, there's no grad jobs for next year. The company just doesn't advertise those positions because it doesn't need them. So if you like, internship is like a long 3-month interview to get a full-time job. And definitely something that is very, very important. I would argue it's more important than grad positions for a very competitive industry like banking. So, and because of this, I'm not the only one who sees that. They've become more competitive. If you think you as an intern are going to get coffee and photocopy stuff that finished maybe 30 years ago, that's not going to happen. You are expected to do a lot of things. First problem is you'll have less and less training because interns are expected to know more even before they start their internship. So they're expected to get a lot of their skills from university and from themselves. So courses like this, more practical courses, Anna's course, Jeff's Student Managed Fund, these are practical courses that are designed to give you very useful skills. And employers, even if it's an internship, you think, oh, it's an internship, they expect me to know nothing. No. You're expected to know a lot already. Even though it's not a grad position, interns are expected to know more and more. And you get less and less training. Training was 4 days at Credit Suisse for a 3-month internship. And I know some banks in Sydney don't even have training. You're just expected to know it. And you can get frustrated if you want and angry and complain that nobody showed you how to do it. Nobody cares. Yeah. You just don't care. Yeah. Banking is for front foot people, for people who have the initiative. If you're passive, banking is not for you. Yeah. So the level of competition among interns is also going up. One false step, mistake, or a bad impression during your and your job offer may be next year may be in jeopardy. So think of what that is trying to say is think of internship as a long interview, and you have to be professional. You have to take it seriously, and you have to take it as an opportunity to show the skills you have. And don't get upset at people. Don't yell. Don't complain. Don't put bad impressions during the 3-month process. Take it. Be professional. Yeah. So this is very important in my opinion. These internships. So definitely take it seriously. So for the interview, for these internships and grad positions as well, usually your CV, your resume, and your grades from university are used as an initial filter, right? Then usually with these bank positions, you're asked to do psychometric testing. So again, quant type, usually some qualitative, but mostly quantitative questions, which is applied as a second filter. And if you have the option to practice these via dummy applications, do it. By dummy application, I mean, this is what I did. Credit Suisse, so the moment you applied for internship, you got a link to do some online test automatically. So if that's the case, submit an application, a fake application, your CV is a blank page, and you get this link into a inbox that you just created, and practice. Practice a couple of times, and then once you're ready, submit your real CV using your real email address, and then do the test that you've practiced 2 or 3 times. Yeah. So a lot of companies don't allow that, these multiple practice or these dummy applications, because they screen the application before you get the link to the online test. But if they do it. It helps. If you're unprepared, first of all, a short interview is not good, by the way. The longer the interview, the better. So short interviews are quite stressful, right? They're not fun. You feel very anxious, yeah. But don't have the mindset that, I want to get out of the room as soon as possible. Yeah. And a lot of people do. I saw that with graduates. That this is horrible. I just want to answer the questions and leave quickly. The shorter the interview, the worse. Short interviews are bad. It's a bad sign. It means they're not interested in you. They don't want to waste their time asking you more questions, right? The best interviews I had was actually a discussion. He didn't ask any questions, right? We were talking about financial markets. We're talking about value, right? We're talking about a lot of the things that I try to teach you in this class. We're talking about NOPLAT, DCF, perpetuity, continuing value, a lot of things. Talking about interest rates, debt, leverage. Yeah. So, and the interview went 45 minutes. He didn't ask me a single specific question, right? We were talking about stocks, right? So, if you think a short interview, if you're anxious and I want to get out of the room as soon as possible, so give very short answers, not good. Don't do that. The longer the interview, the better. Be prepared to ask a question at the end of the interview. You will get an opportunity to, and you should not say, I don't have any questions. So this is a common mistake, is when you will always be at the end of the interview asked you'll be given an opportunity to ask a question. And if you say, I don't have any questions, that's bad. It means you're not interested, and you're just anxious and want to get out of the room. Remember, if you're anxious about doing the interview, you're going to be anxious at work. They're not interested in anxious people. They're interested in motivated, front-foot people who care. So that's a bad sign. Never end an interview by saying, I don't have any questions to ask. Thank you. That's a mistake. You'll be asked, so have a question or 2 questions. I always had 2 questions prepared. You will be also asked during any interview, why do you want to work for us? Right? And this worked for me. There's nothing wrong with saying you offer a challenge and you pay well. Right? It's very direct, and people don't like talking about money in interviews. And it's not like, don't ask how much do you pay. In a bank, starting salary for a graduate in Australia is $125,000. They pay well. Right? So you don't need to ask about money. You will be paid well in a bank. But into the question is, why do you want to ask for us? Why do you want to work for us? Working in bank is challenging, right? It's challenging. So you can say that. You offer a challenge. You're not you're not a job where I basically answer the phone, right, and send emails. You offer a challenge and you pay well. And the crap answers to this question are very, very easy to spot for the interviewer, right? You have a great reputation, and you have all this history, and you made all this money. Yeah, it's bullshit. Yeah. Yeah. So they're bad answers. Yeah. Yeah. So they know they have a good reputation. They know how much money they made, and you don't need to tell them that. Yeah. Another good one is, my friend works for you. Yeah. Not good. Not a good answer. Very bad. Yeah. Don't do that. Interview questions vary based on the job, obviously. Entry positions for interns and grads in banks are typically either in equities or investment banking. So those are the two entry points for graduates and interns in a bank, even in Asia as well. So guess what we did in this course? We did equities. And what do investment bankers use? DCF models and ratios. So the stuff that I try to teach you in this class is relevant to a lot of your interviews. Yeah. You will be talking about PE ratios, EVM ratios, normalization, right? Free cash flows, ROIC, right? So it's important that you're familiar with these concepts, because a lot of the internships and grad positions for university graduates are in these two, where fundamental value or intrinsic value is critical. Also, your interviews don't stop after the initial interview and you get the job. Usually banks now have interviews during the internship, which is kind of annoying and frustrating. I never liked it, but yeah. And there are also exit interviews. So at the end of the internship, you will sit down with somebody, usually a managing director, and you will be asked, what you learned, what you liked, what you didn't like, what your suggestions are, those sorts of questions. And again, think of internships as just a long interview. Yeah. And I understand people don't like interviews. I don't like interviews. But nobody cares what I like. Nobody cares what you like, especially in banking. Right? So, and at these exit interviews, you'll always be asked, standard question is, given what you've seen here over the last 3 or 4 months or whatever it is, what single recommendation do you have for improvement? I always criticize IT. Right? It's a very safe bet. Usually a lot of these companies have very crappy IT systems. ANU, I criticize IT all the time. It's horrible, right? This is not an interview, but in these banks, because a lot of money doesn't get spent on infrastructure. You would think it does, it doesn't. These IT machines are horrible. Yeah, very slow, they crash all the time, they're not good. So follow all, during the internship, what I found is it's very important to be professional, like I said over here. It's important to follow every guideline, every procedure. That's obvious, but even if you think they're stupid or silly, it doesn't matter. If there's a meeting with an HR person who's not your boss, go to the meeting, take it seriously. Take everything seriously. Everything. It's a serious job. It's not a university. It's really, really serious. So you have to be really, really serious as well. Right? I do not underestimate the importance of HR staff, existing employees. So usually with an intern, I was placed in a team, and you think, I just have to impress my team members, right? Or my direct boss. Nope. Everybody's looking at you. And if you go to lunch with somebody who's not from your team, and he or she wants to discuss your work or what you know about stocks or something like that, don't just say, I don't want to talk about it, something like that. Have a discussion with them. Take them seriously, right? Remember, they are the people with the long-term jobs. You're not. You don't have a contract, right? Your contract ends at the internship, and you want to get a full-time grad position. Everybody's watching you. So it's not like Big Brother, but everybody's watching you and assessing your capabilities. So they're not spying on you, but they want to see how good you are in whatever investment banking or equity sales or equity research or whatever it is. You don't want to alienate anyone. Right? Never complain. Never get angry. The job is frustrating. You'll get angry all the time. Keep it to yourself. Right? Anger and frustration is self-defeating. It doesn't do anybody any good. So internalize it and deal with it yourself. It doesn't matter if it's not your fault. Nobody cares. In bank, you will always encounter problems and be assigned tough work. I used to call them Rambo tasks. I used to get jobs from my boss the boss didn't know how to do it himself, so he gave me to do it, somebody with no experience in finance, which I thought was very unfair. Try to do the best you can, just like in this class with valuation. You do the best you can with the data that you have. I mean, you want more data on, comparable companies, or you want more forward PE ratios for some markets or something like that. I could only get data on some indices, and that's what I gave you data. Do the best you can with what's available. If you don't know how to do something, don't just keep asking everybody. Try to figure it out yourself. Go on Google. Google is a great resource. Right? I learned a lot from Google, and I continue every day learn a lot from Google. So type in your problem, and usually other people, if it's you working on some code or something like that, type it in Google. You'll usually get a response. So you can ask for help, but don't go overboard with the questions, right? These people are busy. They work 100 hours a week, right? They don't have time for your problems, right? So, and you're also, if you figure a problem out yourself, you're also showing to your boss and your team that you are somebody who can work independently, who's, again, a front-foot person, who can figure out something on their own, right? That's what you want. That's the kind of personality that a bank is looking for. Independent, front foot, not a passive person. Never ask the same question twice, right? Means you're not listening. If you, what happens, what I saw at Credit Suisse was, especially among us interns, intern would go to a boss, ask a question, and then just go, yes, 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 then go back, think about the answer, not understand, go back and ask the same question. Right? That's a mistake. Don't do that. If there is something you don't understand, ask a clarification. Ask for an example. That's my always strategy. When I'm in an interview or a discussion with somebody or a student or whatever it is, and I don't understand what the student or the person is saying, I ask, well, give me an example. Right? That's usually how you overcome any something that isn't clear. Right? And that's just not for an interview. That's just as for anything in life. Right? When something's not clear, ask for an example. That's a good strategy. Chances are that you will not like your boss. I like mine, but get over it. Nobody cares what you like or don't like in a bank. Remember, he or she has a permanent job and you don't, and he or she writes your performance review. Right? So you have to be professional. Work diligently. Usually with internships, you have day-to-day job that they give you, and also you have some kind of a long-term and anchor job that you do during your internship, the 3-month some kind of a project. Don't, like you guys with the assignment, don't leave it to the last minute, right? A lot of you left the assignment to the last minute. I didn't mark many, but some of you did, and it was obvious. You don't do that. Yeah, that's a mistake anywhere. So that's sort of general sort of approach that, in my mind, you should have with once you get an internship. And now let's talk about software. Finance works on Microsoft Excel, right? So the stuff I taught you in this course, I forced you to use Excel. Hopefully it's beneficial to you if you've never seen Excel before, but financial industry is based on Microsoft Excel. It's useful, definitely something you should be familiar with. And as you go on, if you do finance, what helps also is be familiar with coding in Excel. Macros, the VBA coding, Visual Basic coding, which is, macro is just a fancy name for a set of code that you can write in Visual Basic that automates something, creates a program to do something over and over again. I would highly recommend, if you want to do finance, that you're familiar with this as well. And there's plenty of videos on YouTube that show you how it works for free. And it's like anything. The first time it's kind of intimidating. You don't know how it works, but you pick it up quickly. Right? It requires a couple of days, and you sort of know what macros are, and you start writing your own code. Right? It's important. If you are in a bank doing a trading job or a quant job, SAS and MATLAB are the two programs. SAS less so. Now MATLAB, I think it's become R as well, but MATLAB is the better program. So SAS, R, MATLAB are all useful. Be familiar with those packages. Very important. In this course, we only did Excel, but and 90% of finance is in Excel, but sometimes those packages are also very, very important. What I have last for you is a little bit about working in finance. Long hours, 100 hours a week I had as a junior employee, so 16 hours a day, 6 times a week. I went to the office on Sunday. I had Saturday off, but on average about 100 hours a week, which is a lot. It will vary based on deal flow and time of the year. Obviously, when you're an equity research analyst and the company's reporting its annual or semi-annual earnings in Australia, you're updating your valuation and writing equity research reports. So it's important. So in terms of what I saw in Credit Suisse, if you're selling equities sort of 6 to 6, so quite normal hours. Derivative traders, 8 to 8, so again, sort of 12 hours, quite normal. Investment bankers, you sort of start at 8 and finish around midnight, so it's pretty long hours. Equities, where I was, it's sort of 8 to 11, but it can be longer depending on if there's a reporting season, then you stay there at like 3 a.m. Fixed income, I never worked on that floor, so, but I don't think they work, again, 12-hour standard. Debt market's 12-hour standard. So nothing crazy, but 100 hours a week, it takes it out of you. You're just a human being. So working in finance does have a cost on your quality. But it's not like you have to work 100 hours until the day you die. Usually work 100 hours for like 4 or 5 years, and then it reduces a little bit. So it's not too bad. But less time for yourself, family and friends, and relationships. That's kind of sucks. I put on a lot of weight when I was in Sydney, man. A lot of takeaway, right? So I put on a lot of weight. But it was good food, it tasted good, a lot of salt and sugar. So sleep patterns, okay, but not too bad. It is a stressful job, yes. Because of this, what I'm trying to tell you here is you cannot fake it. You actually have to care. If your attitude is, I'm going into finance because you get paid well, it will not work for you. You have to care, and you have to care about stocks. If you want to do equity research, for example, like I did. And I care about stocks. I read up on it, not just in Australia, but also US as well. How companies make their money, how they beat their competitors, valuation, leverage, all the things I talked about in the course, are things I continue to care about, not that I don't even work in finance, right? So, and the reason why I care about them is because I find them interesting. So, passion is what I'm trying to point at, that's what you need to succeed in this job. You don't need intelligence. You think you need to be the smartest person in the world? No. One girl that worked at Credit Suisse didn't know how a cash flow statement worked. It's ridiculous. I think she was fired. But you don't have to be the smartest person. You just have to care, be professional, and find it interesting, right? And if your motivation to get into banking is money, then that's a bad motivation. Yeah. Even better compensation when bonuses return to the industry. Bonuses have returned to the industry because of the low interest rates. There's a lot of deal flow. So, but money's not everything, And one reason why I didn't choose to stay in banking is long hours, and the pay is good, but again, money isn't everything. I mean, you want to be a human being as well, so it wasn't really worth it for me. Like at ANU, I'm paid a lot less, but per hour rate is fine. I don't need to own an island in the Bahamas to be happy. So, but everyone's different. So this is quite useful. So here is a list of companies that your finance skills are applicable to. Not just finance companies, but also management consulting companies hire a lot of financial graduates. So please pay attention to those as well when you're looking for a job. It's not just banks. So LEK, Booz, Bain, McKinsey, BCG, these three are tier 1 consulting. They are the most prestigious, very hard to get into. Trust me, I tried and failed. A.T. Kearney, Mercer, Oliver Lazard, and Accenture are sort of your tier 2. LEK, Booz also tier 2, so pretty good. And what happens is you might get a job here or like an internship in Accenture and then apply for Bain, McKinsey, BCG, which are your most prestigious firms. Their pay is very good, starting salary $170. Banks and fund managers. So commercial banks, they don't hire a lot of people. Investment banks, do. So Goldman, Citi, MS, UBS, Deutsche, Credit Suisse, JP, Macquarie, AMP. So not just banks, but also insurance companies. Insurance companies are just glorified fund managers. So pay attention to those companies as well. Definitely something that most of these do have internship programs. So I highly recommend those. And some other ones, you know, sort of tier 2 consulting, some Australian government-type organizations, which for international students you can't work there, but for domestics you can. Also, accounting companies have a lot of consulting now. So Corda, Bentley's, the big 4 accounting firms have all consulting divisions, not just accountants. So if you say, oh, Joseph, I'm not an accountant, that's fine. A lot of those have consulting divisions, so they require financial graduates. Yeah, they're all great experience. And even if you, again, if you don't want to work there long term,